Hello, Smart Money Tree podcast listeners, and welcome to this week's show. My name is Kurt Chisholm, and I'll be your host. So today, I'm interviewing Chad Willardson. How you doing today, Chad?
I'm doing great. Thank you.
Good. Well, thanks for coming on the show. Chad, why don't you tell us a bit about your background before we begin?
I spent 9 years at Merrill Lynch after getting a degree in economics. I was in Merrill Lynch wealth management and decided to jump out of the corporate world, leave the big Wall Street bank, and become an independent fiduciary. Started Pacific Capital in 2011 in Southern California. Got clients all over the place, but we are a fiduciary family office serving entrepreneurs with at least 10 million to invest. My role is really working with the entrepreneurs, their spouses, their families. And we've got a lot of smart, great people who are doing the investments, financial planning, estate planning, taxes, all that stuff. So that's my background. Been in the industry now for 22, 23 years, and it's all I've ever done. So I love it.
Nice, nice. So I'm curious. I'm curious to find out more about like the entrepreneurs. You deal with a lot of entrepreneurs. They have some, I don't want to say unique needs, but they're very different than probably most people that are working a W-2.
Yep.
Tell us about what's the life of the entrepreneur like?
It's a roller coaster. I think it's very different. They don't really do the traditional linear path in anything, not in their career, not in their financial life. Most of them don't believe in retirement at all. So I don't work with executives. I don't have CEOs or doctors or lawyers or those kinds of clients at all. I really work with kind of the wild brain thinkers, those who are just out there trying to create new things and have a completely different non-linear path towards their future. And that, even cash flow planning is different for these types of people because there's so much uncertainty, and oftentimes they'll get a new idea and it takes a lot of time and money from their financial life and their personal life that they're committed to jumping into a new venture or new partnership or collaboration. So it's definitely it's not for the faint of heart. It's a very unique space to be advising in. I understand it because I'm one of them. I am an entrepreneur myself, have multiple businesses. And so my team kind of understands how to deal with the weird ideas and brain that I have. And so we understand our clients as well. So it is definitely different.
Interesting. Yeah. I mean, so talk a little bit about the cash flow. I mean, I notice, every time we work with entrepreneurs, you almost have to, turn your brain around 180 degrees just to figure out how to deal with them separately because the issues are, while they're similar enough, the way they handle them is very different. So talk a little about the cash flow issues.
Yeah, I feel like entrepreneurs are a lot more comfortable with risk and debt. And so sometimes you have situations where they need more money than they have liquid or available. And so you've got to come up with creative ways to steady the cash flow. And oftentimes that's short-term debt. They definitely don't have an easy plan to build around. So they're looking at the next year. It's not easy for them to say, well, this is my salary, and therefore this is how much I'm going to save and invest every month regularly. I'll send direct deposits. Like, it doesn't work like that. Entrepreneurs could have a massive year of cash flow and invest and save a lot. And the next year they could have nothing, so it is more of a flexible, fluid financial planning experience when you're dealing with the uncertainty of their cash flow in their different businesses or capital calls or real estate things. There's just lots of different moving parts at the same time that you've got to prepare for.
So, I mean, it sounds like they're comfortable, but in the traditional financial planning, there's no uniformity to it. Most people are like, oh, just save $1,000 a month and into
Yeah.
college and it'll be great. But with entrepreneurs, like, how do you plan around that? Because obviously, like you said, some years they might have a windfall, and other years it might be a drought.
Yep.
And I imagine there's a lot more complexity that goes into that than just the traditional W-2 people.
Yeah, it's completely different. I think you have to have lots of different levers that you can pull on for them. You have to think about liquidity, you have to think about access to debt and credit, and you need to have experience in that game. It's not similar to planning for someone who's got a mortgage, a second house, and a couple W-2 salaries and maybe one rental property. Like, to me, that's a very different approach to how you're going to make changes. Those people are probably more steady in their planning, They're not coming up with things that are out of the blue that are expensive or having some catastrophic cost that they're not prepared for. So you just have to be prepare their financial plan to be more nimble and definitely be looking at what if this, what if that, and have different scenarios so that you're prepared for those calls that come in inevitably in an entrepreneur's journey.
Okay. So I know one thing that typically comes up a lot is, most employees are saving, they have assets, they have a 401k, they've got, cash and things like that, but most entrepreneurs are typically asset rich and cash flow poor in some ways. So how should entrepreneurs think about that part? How should they think about their asset and liability part of their balance sheet?
One thing I've often said, and I've heard it somewhere before, is that people get extremely wealthy, and some people call it rich. Some people, you get extremely wealthy and rich by concentrating your investments into specific areas, and you stay wealthy and stay rich by diversifying and spreading out. And so a lot of these entrepreneurs are building something in a concentrated way, and typically their money's tied up in their equity in their business, and they're going to have a liquidity event. We're helping a few partners right now sell their business for $864 million. It's going to happen in the next couple months. We've been planning it with them for a while. We're getting in on all these tax planning meetings. And, they're going from having very few cash flow liquidity or liquid assets in their accounts to having nine figures in their accounts individually, each of these couples. And that's just kind of the roller coaster that entrepreneurs go on. They don't have typically a lot of money just sitting on the sidelines. Our clientele have at least $10 million to invest. So we're not coming in at the beginning of the entrepreneur's journey. We're coming in after they're already making and saving a lot of money. Oftentimes it's after a liquidity event, like what we're about to do for this client, but they don't look at it the same. They don't have such a liquid balance sheet. Our challenge for them is often helping them balance and have the right proportion of their money in liquid and public accessible investments versus private deals, because typically they have a very high appetite for risk and a high appetite for private deals. And sometimes they look at the stock market and think like those returns are not very interesting to me. So we definitely do have to help them balance their expectations and balance what makes sense to have in liquid versus non-liquid investments.
Now, do they typically get involved into businesses after the fact? Because, like you said, if
Yes.
you're if you
Yes. They
if you
always do. Yeah,
yeah.
they never stop. Yeah, they never stop. They don't, in fact, the meeting yesterday, it was out of state talking to one of these partners for this big deal. And he's like, I don't use the word retirement in my house. Like, it's not a word we use. We don't talk about it because I'm always going to be creating and generating something new. It might be in a totally different industry. It might be with family members, like he talked about involving his kids and their spouses and their grandkids in the next venture. So they don't think traditionally where you're going to stop working one day and then you're going to go golf or you're going to watch the news or you're going to have a cigar and relax on the porch. Like that's just not in their DNA. They've got to keep doing stuff. So you just have to plan almost for like multiple career journeys, and they may or may not be in a similar industry that they're used to.
Yeah, so it brings up you mentioned household and kids. It brings up some interesting issues. We had Michael Sonnenfeld on a few times in the past to talk about the journey of the entrepreneur when they sell their business and the impacts on their kids. What does that look like in your experience? Like, how do entrepreneurs deal with that, with newfound wealth or even wealth with children?
It's a challenge that you got to prepare for. Some of them are very grounded and they've really talked to their family about financial education beforehand, and they've done some estate planning and family planning. Others, it could be a problem where they just get a bunch of money dumped on them, and you've got some family members who are more needy than others and who have their eyes on the prize and eventually are trying to get their hands on some of the money. So it definitely can create challenges and drama if you don't prepare well. And I believe a lot of that comes through financial education and discussing what this money means to our family. What is it for? That money is just a means to an end. It's not the end. And here are the family values we have. A lot of these clients are setting up charitable foundations as a family. They're getting their kids involved in charitable planning and doing work and finding groups causes that they care about. And those are the families that are going to be successful over the long term. And there are other families I think that could really squander a lot of hard work and wealth if they don't prepare properly.
So what are some things that you've seen that work well in that regard to teach the younger generation some good money hygiene, if you will?
Yeah, I mean, I wrote a book about it. It's called Smart Not Spoiled. It's how to teach your kids to be smart about money and not spoiled. There's there are a lot of things online now that I think are great educational tools for families and even young kids to learn about. There's a great book out there written by a friend of mine called Value Creation Kid. Talks about teaching your kids about how to be valuable and how to earn money and just be innovative and creators and entrepreneurs. Um, there are a lot of online programs. There's stuff through Dave Ramsey. There's stuff through PragerU. There's a lot of different courses that you can teach younger generations about money management that I think really help prepare a family to receive a lot of wealth. But I think the most important thing you can do is have those conversations early and talk to the family about it. The problem happens when the families don't talk about the money before the money comes, and everyone's got different thoughts and ideas and expectations, and there's no real clear understanding, and there's no alignment. And so the first step is really having that conversation about what money means to our family, and having that as early as possible and consistently. Don't make it a one-time thing.
Okay. Now, what about, you mentioned you do more family office stuff with these families. What is the reason for having a family office as opposed to just working with an advisor?
For us, I think it makes sense when a client has at least 15, 20, 25 million dollars that they're investing to have more support, to have a group that takes care of people like you, that understands the issues at hand. There's more opportunities for tax and estate planning. There's just more tax things involved when you have that level of wealth, especially when you get north of 100 million. There are a lot more things that you can and should do as a family. So if someone has $5 million, I don't think you need that level of support and service. But when you start getting up into the 8 figures and 9 figures, especially, you definitely do. But we'll do things. Just these people are used to being treated well wherever they go and having some special privileges, and so we'll book travel, we'll book excursions, hotels, flights. We'll do a lot of the nice white glove, soft touch services for travel and other things like that for our clients that they're used to. They're used to that level of VIP service. So
Nice. Um, so are there any other issues that come up that you've seen that are outside the norm for normal people that people, either entrepreneurs or people of that low wealth, should be prepared for?
I just think entrepreneurs need to be working with entrepreneurial advisors. That's something that there are tons of great financial advisors in the United States. Tons, hundreds of thousands. I'm sure there's many great financial advisors. And there are a lot of investors and families out there that need advice. I think that there can be a much better matching program where people work with those who are a fit on both sides. I'll give you an example. Like, I have 5 kids. I would never take parenting advice from someone who's never had kids. I wouldn't go to the gym and hire a fitness trainer of someone who is eating donuts and McDonald's and never exercises. I want someone who's doing what I'm trying to do. So if, as an entrepreneur, I would take financial advice from someone else who's an entrepreneur. And I think there are financial professionals at all different specialties, and you should work with people who specialize in who you are. And so I definitely don't try to be all things to all people. I tell CEOs, executives, doctors, and lawyers that, look, there are great financial professionals who work with more people just like you. I don't work with doctors, so I can't profess to have any kind of expertise in what you're doing and what you're going through. And so when they've come to us and try to become clients, I let them know very honestly that there's probably someone who's a better fit for them, because I work strictly with first generation wealth building entrepreneurs. That's who I work with.
Okay. So, but I would imagine you said you work with first generation, but at some level, it's at some point people pass the second generation. Do you continue working with them, or do you find other people that are a good fit?
Yeah, most of our clients right now have not passed on to that phase yet. What the distinction means to me is that it's the creative founders that we work with. I don't have people who inherited a bunch of money and then become clients, because those people think very differently about money. So our goal is that we train the next generation to still be wealth creators, even though they might be children of successful entrepreneurs.
Okay. Uh, so tell me there, I would imagine there are, you mentioned money mindsets early on. What are some detrimental money mindsets that you see that people have that are kind of working against them?
Scarcity mindset. I see people who have lots of wealth, but who were raised to think that it's always going to run out and there's never going to be enough. And so, we had a client who had many, many millions in their accounts. They had lots of cash flow. They had real estate. They had no debt. And the husband wasn't willing to buy new carpet for the house, which was like $4,000. Even though their cash flow every month was in the six figures, he felt like they couldn't afford new carpet. And so he was willing to just almost go through this miserable argument with his wife every single year. And I really tried to persuade him not to, because it was like, that's a real scarcity minded thought, that you can't afford something that's less than 3% of your monthly income. But that's just the way he was raised, and that's kind of how he thought. So I think a lot of the money blueprints that we learn as children carries with us the rest of our lives. And if we don't do any trauma healing on that, then whatever our parents ingrained into us is going to stick with us forever, for good or for better, for worse.
Yeah, and that's the scarcity mindset piece is really important. I'll ask because this obviously comes up is, there are a lot of people who are successful in part because of that mindset of pinching pennies. I mean, it was one founder I remember talking to who doesn't waste paper. If
Right.
there's half the paper is unused, who tear it off and put it in a pile, like, here, use this. Like he doesn't waste anything. And some people, that's the nature of their culture. So how do you separate that and differentiate that?
Yeah, I think there's nothing wrong with being thoughtful and frugal about your money, but I think there's also a tendency for some of those personalities to spend nothing, enjoy nothing, and then dump millions of dollars on a very unprepared and perhaps entitled next generation. And it was kind of all for naught. I've heard that quote before, that's like, if you don't ever fly first class, your kids and grandkids certainly will. And so I do believe that there's something to be said about enjoying the fruits of your labor while you're alive, and not scrimping all the way until your 90s and then seeing the next generation blow it within 12 to 18 months. So I really subscribe to giving while living. I love to see parents and grandparents doing good while they're alive, and not just after their death, because they get to actually enjoy seeing the philanthropic stuff actually materialize. They get to see helping a kid start a business, or a grandchild buy a house, or do things like that. I think there's just a lot of excellent relationship building within a family, and legacy building, that happens when you give while you're still alive.
Right. Cool. Any other money mindsets that we should be aware of?
I think that's the main one that comes
Okay.
to mind.
Okay, great. Well, final thoughts here as we wrap it up, Chad. Final thoughts you think our listeners should know about, if they're entrepreneurs or they're looking for to improve their financial situation.
Yeah, there's no way that you can, kind of like, you can't out exercise a bad diet. No matter how much you exercise, if you eat really poorly, you're not going to be in good fitness, good health. I'd say you can't really out earn bad financial habits. So people who are overspending and borrowing on credit cards, and making poor financial decisions, and they think that their only problem is they don't earn enough money. If you're not responsible with 50,000, you're not going to be responsible with 100,000 or 500,000 or 5 million or 10 million. So your financial discipline and your good habits of investing and saving and being budgeting and just making a financial plan, no matter how much money you earn or how much you have, those disciplined habits will carry you to the next level of success. And so you've got to actually implement those good habits and those disciplines early on. Nothing changes if you just get a higher income other than your lifestyle creep and you start spending more and you're making poor investment decisions and chasing what's hot or chasing what's the get rich quick thing that you just heard about. So financial discipline and good habits need to start no matter how early you are on the journey. That's going to take you to the next level.
Awesome. Great. Well, Chad, I really appreciate you joining us and sharing your wisdom with us. Where can people find more about you?
ChadWillardson.com, or you can check me out on LinkedIn. I'm there all the time.
Awesome. Well, Chad, I really appreciate you coming on the show and look to having you back on in the future.
Thank you very much.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. I mean, like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
All right, well, that was a great interview with Chad. Really appreciate him coming to the show and share his experience with us. Now we're into the panel portion of the show where you have our very own Barb Freeberg. Hey, Barb.
Good morning, everyone. Happy
Great.
to be here.
Glad to have you. We also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk. Happy to be here as well. Good to see you.
Great. You too. You too. Well, let's just dive right in. So, Barb, what were some of your thoughts from the interview?
Wow. I had a lot of thoughts. They ranged from raising money responsible kids. Side note, don't give your kids everything, even if you can. Other thought is you have to save from retirement, regardless of whether you have a cash flow, uneven cash flow, as well as whether you think you will retire or not, because we don't know the future and we don't know how much we'll be able to work when we get past a certain age.
Yeah, that's really important. Phil, what about you? What are some of your thoughts?
I think one of the things that struck me as I was listening was the idea of, he said a lot of the people he works with, they don't know when they're going to retire, or they're not planning on it. Because it's a conversation that I had with my son the other night. He asked me that question. And the whole idea about uneven cash flow and diversification, like that also comes up here, right? When we have our business, you got a lot of eggs in one basket. You work for a company and they give you company stock. He talked about the idea that I really liked was that we concentrate to get wealthy, but then we have to diversify to stay wealthy. And I thought that was a really interesting take on that.
Yeah, no, I agree. I think it's you know, a lot of us don't live in this world. You know, a lot of us are employees or we're small entrepreneurs or consultants or whatever. But, you know, when you get into the world of the entrepreneur, the larger company, uh, people of greater wealth, there's more complex challenges. Um, so one question that comes up, it came up in the interview, and we certainly want to talk about it here, is company stock. So when you have whether you're working for a big company or whether you're working for yourself, how should people be thinking about company stock? Because a lot of times people have that as a big part of their compensation, and sometimes 90+% of their wealth is tied up in one single company. So Barb, how should people be thinking about that?
This is such a tough one, especially if you work for a company that's very generous with giving their employees stock, and the company is impressive, it's well regarded at Google and Amazon, Facebook, and you're sitting there with tons of company stock and it goes up and up and up and up and up. And the thought of selling some of your company's stock and then reinvesting in, say, a diversified equity fund, a S&P 500 index fund, or a total US market fund, you may see that as trading in gold for, you know, something less valuable. I don't want to, you know, say what metal that might be, but the idea,
Hypothetically, silver.
yeah, I was going to say
Yeah.
silver, and then I was thinking, you know, I'm not enough up on the metals markets to know if silver is really worse than gold or not. So
Not worse, less expensive.
less expensive. Okay, so there, good example. Thank you, Kirk. So really in investment lore or investment theory, it is not a good idea to have all your wealth concentrated in one area, regardless, even if that area is awesome, because the idea is you don't know the future. And if that company were to have difficulties, I look at GE now, which was a darling of decades and decades and decades, or I look at some of the greatest companies of 50 years ago, and they're not on our radar today. So, in order to save yourself from the potential of great losses in the future, it is wise to diversify away. Sell a portion of your company stock. Invest it in a diversified US or global index fund. And you may feel a little pain now, but it's a more sensible, less risky or stable way to help you even out your returns, your potential returns, and your potential risk. Now, there may be some FOMO, some regret, think as you see your company stock going up, 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 more than the regular or the overall stock market. But in the end, it will remove some of the risk. Now, if you're a huge risk taker and you're willing to gamble that your company stock is going to continue ad infinitum to outperform the broader stock market, then all means, just stay with it. But for those of us that are concerned about risk and want to modify the risk of our investments, it's really a wise decision to sell some of your company's stock.
Yeah, I appreciate that, Barb. What are your thoughts, Phil?
I agree with the idea about not holding too much company stock, and I'll give you even more dramatic examples. Go back to 2008 and Enron. So many people thought they had all this money because Enron stock was the darling and the stock went up so much. It ended up as zero. That's not what you want to have happen. It's nice when you have, Barb mentioned some great companies, Google, Amazon, Facebook. Those stocks have done tremendously well. And if you have a lot of that stock because you work for those companies, you're doing great. But I've had a conversation with clients a lot about how much do we really need? Yeah, it's nice to have that, but is it worth that, hoping that that's going to continue to grow like that? Because not all stocks continue to outperform the market year after year after year. At some point, that's likely to stop. or at least there's going to be a pullback. And if the pullback's at the wrong time, it's just as bad if it stopped altogether, right? So you want to diversify to protect yourself. You want to be able to have the quality of life that you want now and in the future. And is it really worth just keep trying to build that pile of money without taking a step back and saying, how much do I need? What is it for? What is this going to let me live my best life? And manage it that way. So diversification makes a lot of sense. Just like the idea that we don't know, we might say we're an entrepreneur and we're going to work forever, but things happen. Something can happen to you and maybe you can't do that anymore. So that means along the way, you want to be saving for retirement too. It doesn't mean you can just avoid it because I'm going to keep working. I'm not going to need it. But what if something happens? So you want to make sure that you're prepared for the future. That's all part of this. And diversification is part of helping you to prepare for that future.
Yeah, I want to bring up two frameworks associated with this that I think are important. One is that frequent when we talk to people, if you're looking at your own company stock, so let's say you have 90% of your wealth in a company stock, no matter which company, it doesn't matter. I think the first part is obviously knowing your company, right? If you're working with an advisor, you're probably going to know your company better than the advisor will, no matter what they say, because you work there. The advisor doesn't. The advisor's reading public information and whatever, and maybe there's some added advantage. But generally, when I talk to people, I say, tell me about the company. Like, how well do you know it? Are you an executor, an insider? You're going to know it better than me. If you're like a lower rung kind of person, entry level person, you probably won't. But most people that have enough wealth built up in the company are high up enough where they know what's going on. And I don't mean insider information, but they have a good sense of whether the company's growing or not, or problems or whatever. So I think that's really important. But also, I think the framework to really take away from this is most people think it's an all or nothing decision. I should keep all my company stock or I should sell it all. I mean, Phil mentioned Enron. You could also mention Lehman Brothers, Bear Stearns, WorldCom. You go down the list, and there's a ton of these that had this issue. And so most people look at it, should I keep it all or not? I mean, look at Bear Stearns. The people have been working there for decades and had like tens of millions of dollars in the stock and it all went to zip. And these are people who are really wealthy and they didn't diversify because they're all bought in. And so I think when you're thinking about your company stock, just being mindful of the risks associated with it, you don't have to say, I'm keeping it all or I'm selling it all. You could take some derivative of that and say, hey, every year I'm going to sell X. Every year I'm going to diversify a certain amount. Now, do you give up some of the upside? Yes, you do. But you also take money off the table. And so when people are looking at their stock, we're like, well, I'm in a Blavidia stock that's going through the roof and it's up, 800% this year. I never want to sell. Okay. You could look at any sort of, cryptocurrency and say the same thing. Well, it's up 10,000%. Why would I sell it? I don't know. Maybe because it could also go to zero. And if you don't acknowledge that, then you're not an investor, you're a gambler. You have to acknowledge the fact that this stuff could go to zero. So what can you do to diversify your risk? You can take some money off the table. Yes, you do give up some upside in exchange for that. And Warren Buffett talks about it. And, if you had put all your original money in, you would have had this amount of money had you started at the beginning and never took money out. That's all well and good for Warren Buffett, but it's his company. So if you're investing in your own company, okay, you can take that chance. And we're not telling you not to. We're telling you that you need to understand the risk you're taking. And if you're concentrated, it's not a bad thing to take money off the table as it goes up, because every year you get more stock. Every year you can liquidate some and take some profits. It's just a good idea to have some money, because even some of the people who lost it all, some of the executives and some of like the Enron, WorldCom, Lehman Brothers, Bear Stearns, even they had some extra money on the side, as for their house or whatever. They had some other assets, even though most of it was tied up. So don't be afraid to take some off the table so you can enjoy life along the way. So that's the first thing. The second thing I want to mention is taxes. And then I'm going to go back to Phil on this because Phil's a reformed tax guy, is taxes. Now, most people also think, well, I don't want to pay a lot of taxes on this stock. All right, let me just break the news. You're going to pay taxes on the stock at some point in time, whether it's now or 6 months from now or 10 years from now, you're going to pay taxes on it. well, what if I leave it to my kids and I don't have a step up? Okay, what if it goes to zero? Right? I mean, you can't predict the future. And I talk to people all the time. They're like, well, I don't want to sell it. It's gone up so much, and I have to pay 20% in long-term game taxes. Okay. So what if the company you own goes sideways for 10 years and makes no money? Would it have been better to sell it all, hypothetically, I'm not saying you do this, sell it all, pay 20% taxes, and put it into something that was growing for the next 10 to 20 years? Like, paying taxes is not a bad thing. Too many people are afraid to pay taxes. They don't want to pay taxes. You're going to pay taxes. It's okay. That means you made a good investment. Pay the taxes and find something that is good, right? It doesn't have to be one company. It could be diversified. It could be in something else. But tying your eggs up in one basket risks you not making gains in a year that other people are making gains. Just because there were gains in the past doesn't mean you're going to say this, have the same gains in the future. A perfect example is look at this year. Look at the Magnificent Seven, as they're called, right? Not all those companies are going up this year. I mean, Tesla's down right now. I think like 20 some odd percent. Apple's down, and I forget which other one. But not all the Magnificent Seven are going up this year. Is my point. Some are, and some aren't. So does that mean it's going to go up forever? Not necessarily. So just keep in mind that there are always stocks going up and there are always stocks going down and some are going sideways. Just because what it did in the past, like the Magnificent Seven have done so well for so long, it doesn't mean every year it's going to be the same. And it doesn't mean they can't have a sideways moment. I'm going to ask Phil because you probably remember this. What was it in the 80s? What were the stocks in the 80s? I'm drawing a blank on the name that everyone was going after. It was like large cap. Um, what was it? It was like a thing. Everyone wanted like the blue chip stocks in the 80s and had to be these blue chip stocks. It was like
You're talking about
IBM.
the nifty 50s in the 70s?
Yeah. There was the Nifty 50, and then there was the Dogs of the Dow. I think that's what it was. Dogs of the Dow in the 80s. So there's these things. People are like, oh, you got to invest in this, and it's like, and then it's a passing fad. It always is, right? At some point. So Phil, what are your thoughts when it comes to like taxes and stock and all that?
So the first thing is an old adage, but it's true. Don't let the tax tail wag the dog. What that really means is don't make all your decisions when it comes to investing around taxes. Taxes matter. And what I do when I work with clients around taxes when we do planning is think about the fact it's not how much you pay this year, it's how much you pay over your lifetime. So there's a lot of strategies and tax planning that we can do to reduce your lifetime tax liability. Now, it doesn't necessarily apply with concentrated stock positions, but maybe we want to do Roth conversions if we have a lot of money in our IRAs or our 401ks because we could pay tax now at a lower rate than we're going to pay in the future. When it comes to the stocks that we own, we always want to make sure that it's long term. There are strategies that you can use to help mitigate it. There's direct indexing where you basically have exposure to the companies in the S&P or whatever index you're using, which allows you to do tax loss harvesting so that you can offset losses and gains. If you're charitably inclined, you can think about giving away some of that stock to an organization because when you give away appreciated stock, you don't recognize the gain, but you get a deduction for the full fair market value of the stock. So that's a great way, instead of taking cash, like think about selling the stock, paying tax on the gains, and then giving away the cash versus just giving away the stock. And now you never paid the capital gains. You, in essence, gave away more because you didn't have to pay tax. You can give away, right? If I sold 100 shares and I had a gain, I'd give away less than the 100 shares were worth. But if I just give the stock away directly, I give away the full market value. So I get that deduction. There's things like that. If you have company stock in a retirement plan, there's some tax planning things that you can use to be able to get capital gains. Because remember, when we pull money out of our retirement plans, we pay at ordinary rates, which are higher than capital gains rates. So there's lots of things that we can do. Tax planning is really important. I'm never about trying to cheat or get overly aggressive on our taxes, but I am about let's pay our fair share. And part of your fair share is looking at it from a long-term perspective and not just 1 year. And again, like it started with, don't let the tax tail wag the investment dog. Don't let taxes drive your decisions. If it makes sense to sell a stock, Kirk said, stocks can go flat, can go down for a period of time. You don't really, and if you think that's what's going to happen, maybe you should sell it because you can make more money doing something else than holding onto that stock to avoid paying taxes on it. Yeah, we get the step up in basis when we pass away. You know, our heirs will get that. But again, make sure that it's worth it to do that.
Phil, I have a question about the direct indexing because I was speaking with a financial advisor the other day who was saying, why don't you get out of your, index funds, your ETFs, total market ETFs, and go into direct indexing? Because I have quite a large portion in those types of investments. How much can you really save if you go into the direct indexing route?
The data that I've seen, Barb, says a couple percent. Now it also depends. Like I wouldn't recommend direct indexing if all your money is in tax deferred accounts because
Oh,
really,
sure.
so really the two biggest benefits that I see, and I've actually recently had a conversation with this about this with somebody, is number one, there is tax loss harvesting that you can do because now you own several hundred stocks instead of just a couple. So
Mhm.
not every stock goes up all the time, and the software that's used for direct indexing look for those opportunities to sell stock at a loss. The other time that I think it works is when so that ties with the concentrated stock positions. The other time is if you have socially responsible investing, ESG, whatever you want to call it, it can work for that because you can do a much better job than the ETFs and the other products that we have out there of identifying stocks that fit within that. But the short answer to your question, Barb, is I've seen it's like 2 to 3% is really the benefit. But you know, we talk about tax loss harvesting, but you can't harvest losses forever, right? So I've got these stocks. I sell the ones that are a loss. Some of them are going to go up and I'm going to run out of opportunities. So it really becomes tax loss harvesting in a way is deferral as opposed to a permanent benefit.
Well, and also I'm thinking I bought these index funds decades ago. So to switch out of them and go into direct indexing would mean paying huge long-term capital gains now.
That's
So
right.
I get the Roth IRA conversion as I'm thinking more about the RMDs. That makes perfect sense to me. The direct indexing with index funds that I owned, selling those, paying tax at the capital gains rate, and then investing in direct indexing does not seem to make a lot of sense.
No, it doesn't. It's more strategy for new money, or you have a big piece of your portfolio that you could get out of without paying a lot of tax because it doesn't make sense to recognize taxes and pay taxes to try to save money on future taxes. That really, there's a big disconnect if that's what you're doing it for.
Yeah, it's interesting. I mean, yeah, I mean that gets into, in a sense, kind of like sector rotation in a way, because you're selling stuff that's out of favor. You're buying, you're kind of rotating sectors based on what's performing, what's not. But taxes, I think, taxes are an important thing to consider, but not, as Phil said, the tax tail shouldn't wag the investment dog. And I think most people focus on that way too much. Now, I don't like paying taxes any more than anyone else, and I'd prefer not to. Certainly, because I don't think my taxes are getting good use right now, and certainly I don't want to pay them. But we all live in a world where this is just part of it's. If you're a gambler, you know about the VIG. It's basically the VIG. This is your price of entry into our society is paying taxes, whether you like it or not. So I do want to ask one more thing before we kind of wrap it up here, which is retirement. I mean, when you own a business, when you're an entrepreneur, a lot of people tend to not want to sell, or they have trouble selling or moving on. I'm just curious for each one of you, Barb, how do you think people should look at as an entrepreneur? How should they be thinking about retirement?
You know, that's such a tough question. And can be looked at in so many different ways, and everyone is different. In the philosophical sense, many of us have our self-worth tied to our work. And so the idea of retirement is we are giving up what we think makes us us, and then entering a life where we are less than. And that's just a construct, a philosophical construct. It's not a fact. It's a belief. And so that colors a lot of people's retirement. Now, I know this is not a psychological podcast, but I throw that out because it's a reality. And I know you two, as financial advisors, probably see that all of the time. As we get older, we become less competent, or maybe some of us want time to do other things. Others of us love our work, don't ever want to stop. But the reality is we're going to be working less at age 70 than we worked at age 40. That's just how it goes. And so maybe you're going like my husband, he quit his salary job, or I would say quit, he retired from his salary job, but still has a ton of consulting work. So he's very, very, very busy. Our income is going to take a hit from that, though. So I think the bottom line is you want to save for retirement, whether you think you will retire or not. And that means, and I'm going to turn this over to Phil in a minute, that means if you cannot get into an IRA, a Roth, a traditional, or a 401k, and you have your own business, you might want to look at a simple IRA, a SEP IRA. But whether you think you're going to retire, you're not going to retire, you're partially retired, you're working in retirement, the idea is during your working life, you're going to have made more money than you are after you're age 70. So it's a good idea to put some money away from age 20 to age 60, 65 to use for the next segment of your life.
What about you, Phil? What are your thoughts on this?
I think it's really important to save for retirement because we don't know what the future is going to hold for us. And people don't always realize that when we're not working for a company, there's a lot of other ways to save. Barb mentioned some. There's simple IRAs, there's KEOs, which are self-employed retirement plans. There's also solo 401ks, and you also have Roth options in these plans. And so they're important in a couple ways. One, we talked about taxes, and if you, depending upon what type of account you have, you can get a tax break for what you put into those accounts, the same as when you put them into your 401k or your 403b if you're a public employee. So you can get that tax break. You can also position yourself to have some money. The biggest thing that people ask when they retire is, so I don't have a paycheck anymore. Where's my money going to come from? They don't think about the fact that they saved all this money, and I call it a retirement paycheck. That's what we're going to build. You're going to have your Social Security. If you have a pension, that's going to come in. You got this money that you saved for retirement, and we're going to figure out how much you can withdraw every week, every month, however it is that you want it, so that you have money coming in. It's just you're paying yourself. All the money that you saved during your lifetime, during your working career, now you can pay yourself. And it's really important to do that. It helps with tax efficiency. Also, if something happens and you can't work as long as you want, well, at least you have something there. It's really important. Retirement is a difficult concept. Different people have different ideas. I mentioned that my son asked me, and I don't really have tremendous plans to retire because I love the work that I do and I want to keep doing it as long as my brain lets me. I may not do it as much because there's lots of other things that I do, but the virtual world that we live in will let me keep doing it no matter where I am at the time. But I'm still saving for retirement because I don't know it's going to end up the way that I expect. Things happen that we don't expect all the time. Just like the market, our lives have unexpected occurrences in them. So we need to prepare.
Yeah, I think that's great advice. Well, I think as one of the things that I takeaways I got from the interview was I want to kind of re-mention these two quotes, which is you cannot out earn bad habits, which I think is really important. And also, if you don't fly first class, your kids definitely will. And when you think about people when they're retiring, a lot of business owners, especially first gen business owners, they work really hard. They create something great. Usually, second generation, they instill enough values in the what do they call it? Shirt sleeves or short sleeves in three generations or something. Maybe I botched the quote, but the point is the first generation works hard, they build something. Second generation usually has that work ethic built in because of because of the fact they had to work at it too. And then the third generation is usually a mess. And this is everybody. This is like human nature. It happens all the time. It happens so much that there's quotes around it. And so there's just other things you should be thinking about, which is, if you're thinking of handing your business to your kids, is that the best use, right, of the money? Maybe it is. Maybe they're working the business. Maybe they're earning it. That's great. But maybe it's not. Maybe you're giving them something and you're actually creating bigger problems. So all these things are things people should think about. Is this the best approach? Not just what I want to do for my kids, but also, is this the best approach for their future and their kids? And so it requires a lot of time and thought. And when entrepreneurs are retiring, most of them don't want to. I can't see myself retiring either, but of course I got many years ahead of me, hopefully. And I'll just keep working. I enjoy it. But maybe work less, but it's a puzzle, and I enjoy puzzles. So it's you're kind of, as an entrepreneur, you're trying to figure out these puzzles. So all of these are really important questions to ask as you're going through this process. So I know there's a lot of entrepreneurs listening to the show, and certainly if you have questions, you can let us know. But I think that as an entrepreneur, the challenge you have are similar but different than employees, in large part because you've got this other responsibility, which is your company. You have employees you have to think about, you have a legacy to think about, continuity, things like that. So a lot to think about, and you shouldn't go in just focused on the money. You have to go in focused on all the other aspects that make your company great. So we're going to wrap it up here. Final thoughts, Barb, final thoughts from you.
I got a recent email from an entrepreneurial colleague, and he said to me, my business has done very well recently, and I want to contribute more to my retirement. Can you recommend any portfolio optimization books, those sort of things? So I recommended a couple of asset allocation texts to him, portfolio construction. But the takeaway for me is what great thinking this colleague was doing. He wasn't thinking, oh, my business is going well, I'm going to go out and spend. He was thinking, how can I take the money I'm earning now and ensure that I will have a more stable financial life? So we don't know the future. It's wise to prepare for the unexpected. I am Barbara Friedberg. You can find me at Barbara Friedberg Personal Finance and at YouTube. See you next time. Bye.
Thanks for coming on, Barb. And Phil, final thoughts from you.
When it comes to your life and your future, it's important to prepare. Saving for now and in the future, we have a lot of competing things. You want to figure out what's important to you and make sure that you're prepared. We don't know what's going to come next. We want to make sure that we're prepared so we can have a quality life all the time, not be like the client and prospect we talk to will say. The one thing I don't want to do is I don't want to be eating cat food when I get older. Oh, if you prepare, we can avoid that. That's why we plan. Experiencing big life transitions, and retirement is one of them, can be stressful. So my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm is Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook, and you can also sign up for our blog. Thanks for having me today.
Thanks for coming on, Phil.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.